Brad Williams, Frugal Finance. This one's going to shock you because it shocked me originally. What do I mean by that? I lost $100 betting against this hypothetical. Somebody said, look, well, I guess I probably brought up the argument is, look, the true cost of borrowing, say, an $80,000 loan to a $90,000 loan from 12 to 13% is 1%. In other words, an 8% loan you can get at 12%. A 90% loan will cost you 13%. Keep in mind, I owned a mortgage business for a long time. It didn't dawn on me the actual cost. It cost me $100 and a lot of embarrassment because it's rather fundamental. It is significantly higher. Now, 10 grand will bump up that rate considerably. So let me show you what we're talking about here. Again, we go from an $80,000 loan to a $90,000 loan. The difference is 12% to 13%. 25 years. Doesn't matter. It could be 30 years. It could be 20 years. Here's a scenario. 90 grand loan constant. We can use all kinds of variables here. We can use Excel. We can use present value tables to do this. We have a monthly payment of $1,000 on the 90%. On 80 grand, it's $842. Here's the key thing, $172 difference. Here's how you compute it using this payment. And we've done this a million times. So there's no surprise here. Here it is for 13%. The true cost of borrowing, effective rate, or the change, is $172.47. But what's that cost? 20.57%, not the 13. So keep that in mind. Not a 1% difference, 20.57%. How do you figure this? What we're doing is taking the present value and we're computing this 172.47 difference over a 25-year period. Your 20.57% is a shock. Now keep in mind also that 80% is a typical normal conventional loan. You start jumping up above 80%, let's just say this was an 80% loan. That's just a normal conforming loan. As soon as we go above that, there's considerable risk. Maybe the lender's entitled to that added cost, that risk factor. From your point of view, you're going to shrug it off as a 1% increase. Don't. Because you can see how this is going to trickle down across the board. Keep in mind, frugal finance. This is my job. Frugal. We're trying to figure out alternatives. So what are the alternatives? One, if you don't need to borrow the extra 10 grand and it's going to cost you 20% at that additional 10 grand. You can either A, find a better investment. In other words, your 10 grand, if it only earns 8%, it's going to save you 20%. Or you take a second mortgage at a lower cost than 20.5%. And that's common. You take a first at 80% and a second for 10%. That's the way to go. Now keep in mind, I've pointed this out time and time again, is the other fees associated with this. What happens if you, here we got this 20.83%. And again, this is just a rounding error. If this thing is paid off in 5 years, you're going to see this 20.83%. But now what happens if there's a loan origination fees and other junk? All of a sudden, your rates start going up considerably. If you pay off your deal after 5 years, you're going to pay off 20.83%. That's on the 90% deal. So 20.83, if you're paying an origination fee, you're going to see it jumps up to 24%. In terms of frugal finance, we're trying to figure out why there's so many billionaires on Wall Street. You could start seeing why. People don't understand the numbers. You understand the numbers. You can pass this on, or you could be on your way to be a billionaire because now you know some of the secret. And these are just basic. I'm going to get into some stuff that'll just blow your mind as to how complex finance can get. Brad Williams, Frugal Finance, more to come.